Open.
Okay, welcome everyone. I'm your host, Elizabeth Prain. I'm a lawyer with Moskowitz LLP, a tax law firm, and we welcome to our presentation on the Employee Retention Credit signed into law recently under the American Recovery Act. Steve and Cliff will be presenting. Steve founded Moskowitz LLP because he saw a need to advocate for individuals and businesses. 30 plus years, he is still doing this along with his team of tax attorneys and tax professionals. Our managing partner, Cliff Capdeville, has been essential in navigating the numerous recent changes to the tax code. And without further ado, Steve.
Thank you very much, Liz. And I'm really excited about this employee retention credit, and you should be too. And let me give you a little bit of the history. It's all recent history. It goes back to the beginning of the pandemic. When the PPP, the Paycheck Protection Program, first came out, the government said, choose between PPP and ERC, Employee Retention Credit. And most people chose PPP. Then on December 27th of 2020, the Congress said, only kidding, even if you took PPP, you're not in and of it yourselves disqualified from getting ERC. There's other requirements, but now you may be able to benefit, and you can get as much as a credit. Now, it's not a deduction, it's a credit. So if you have a $5,000 credit, that means the government gives you $5,000. So they said, okay, for 2020, you can go ahead and get a max of $5,000 per employee. So for example, if you had 10 employees, that'd be 50 grand. Then the Congress said, let's extend that to the first 2 quarters of 2021. And then on March 11th, President Biden signed a new law and said, only kidding about that too. Now it's going to apply for the 4 quarters of 2021. So compare and contrast. With the 2020, it's $5 grand for the year, max. With 2021, it's $7,000 max per quarter. So that's $28,000 per employee per year. So, for example, if you had 10 employees, that means the government would give you $280,000. But the benefits keep on coming, because if you've already paid your payroll taxes, that's okay. You need to file an amended 941, the payroll tax form. And because of all these changes, the government has recently amended the 941 3 times, count them, 3. So you can get back payroll taxes that you paid previously. And then the government said, you know what? They're going even further. They're going to give you an advance on this if you ask for it and you otherwise qualify. And what happens now is, rather than paying your payroll tax, you can take the credit instead and retain your cash. So suppose, for example, make up a number. Suppose, for example, you were entitled to a credit of 100. And in the filing you're making, you would normally pay the IRS 30. You say, okay, IRS, I'm going to claim 30 of my 100 credits. So I'm going to give you 0 instead of the 30, and you're going to give me 70. So the bottom line is, this is tremendous, but like everything else, there are qualifications. And you'll see that in 2020, you had to have a dip of 50%, but 2021, you only need a dip of 20%. And also another big thing is moving from $5,000 a year to $28,000 a year. There's so much here. And again, if you had PPP, we have to manage the PPP, because with PPP, in order to have 100% forgiveness, you had to spend at least 60% on payroll. But that leaves 40% on other qualified expenses, for example, rent, healthcare. So what happens, we say, okay, I want to go ahead and manage this because I'm going to ask for forgiveness, but I want to manage it in a way to maximize my employee retention credit. And remember that originally when PPP came out, you had to spend the money in 8 weeks, but then the government said, no, you can have 24 weeks. So what you want to do is first manage what you're spending the PPP on, and then over what period of time to spread it out so you can maximize your ERC. The bottom line is, and this is free money, So what that means is when the government gives you the money, there's no tax on it. And then when you go ahead and you spend it on the appropriate expenses, you get a tax deduction. And initially, when the PPP came out, the IRS said, well, this is free money, so no deduction for you. And then the Congress came in and said, what are you talking about, IRS? This wasn't the intentional Congress. Yes, of course, you can have a deduction. So one of the things I want to warn you about, if you decide to research some of this on your own on the web, be very, very careful, because these things have changed and changed and changed again. And when I look at it, I say, well, if I wasn't already familiar with it, there's a lot of information on the web. But even though a lot of it's recent information, even that is outdated. So that's why I'd say pay careful attention to our webinar. And if you compare and contrast, remember, there have been a lot of recent changes. And on that happy note, I'd like to turn things over to my friend and colleague, Attorney Cliff Capdeville. Cliff, take it away.
Thanks, Steve. Yeah, picking up on your point, this is really a work in progress. We don't have much guidance with regard to this latest round of employee retention credit changes that came about with the American Rescue Plan. We're waiting that. So there's an asterisk here. Check in with us regularly, because there will no doubt be changes as we go throughout the year. So with that, let's dig in here. So as Steve mentioned, the first issue really is to figure out if you're an eligible employer. So what does that take? Well, very little. Almost everybody who has employees is potentially eligible for that credit. So what does that mean? It means that you are carrying on a trade or business. That's defined in the IRS code as actively participating in a enterprise that is intended to make money. So we'll get into those details in a bit. But that the criterion one is that you're actually in business. It's not a hobby. Number two, that either your business was suspended due to a governmental order. And we'll talk about what constitutes a governmental order for this reason. And the third is whether or not your quarter in question meets the criteria of a significant decline in receipts. As Steve mentioned, that is different for 2020 compared to 2021. The base year for all these calculations is 2019. So if you come to us for a consultation, make sure you have your 2019 tax return with you. And that's going to be what we use for all these calculations. So for 2020, for the fourth quarter, what we're talking about doing an amended return. Now we're going to compare your fourth quarter 2019 to your fourth quarter 2020. If you had a significant decline, and that's defined in 2020 as a 50% drop in gross receipts, then you're going to meet the significant decline prong of this test. So
or if the government closed you up, remember, it's one or the other.
Yeah. So again, three-prong test here, that you were carrying on a business, that the government shut you down, or you had a significant decline in gross receipts. So what is a trade or business? This is in Internal Revenue Code, Section 162 defines it as an activity whose principal purpose is to make money. Now, why is that important? Because sometimes people have alleged that they are in business when really it's a disguised hobby. It's unlikely that that's going to come into play much, because if you don't have significant gross receipts in 2019, then you're not going to be eligible at all. So you've got to be in business to make money. So what does that mean in this kind? We often see this in context of a rental activity, whether or not this rises to a level of a trade or business versus being a totally passive activity. So in general, this is what you imagine carrying on a business would be, that you have a separate set of books and records. You keep track of those records contemporaneously, keep track of your time associated, and the dates on which you perform those services and who perform the services. So this is important, whether it's you hire independent contractors or employees. And for the most part, in this analysis for the employee retention credit, we're talking about W-2 employees. But essentially, big picture is this is something that you're actively engaged in. It's not a passive activity without employees. If it's purely passive activity, pure investment, you're not going to be eligible for the credit. This comes up in the context of the Section 199A, the qualified business income deduction that you probably heard about in the past couple of years. But the activities for a real estate business that would qualify you as a trade or business would be advertising, negotiating leases, collection of rent, the sort of daily operation and maintenance, repairs of the property, purchasing supplies and materials to make those repairs, and supervising employees or independent contractors. If you meet those tests, then you almost certainly would qualify as a trade or business, and any payments that you made to employees would therefore potentially be eligible for the employee retention credit, assuming that you were able to also prove a significant decline in revenues. What is not going to qualify? So if these are your only activities, you will not qualify as a trade or business. That's going to be arranging for financing, reviewing financial statements, planning for capital improvements, or traveling to and from real estate. Now, some of those may be deductible. So just to be clear, that doesn't mean these aren't deductible on your Schedule E for your rental property, but these are not going to qualify as activities that elevate you to a trade or business for the purpose of the employee retention credit.
Or is the way I liken it, or your hands, do you get your hands dirty? Are you sitting back in the office looking at reports is different than you're walking around collecting the rents? How am I doing? Painting the wall and fixing the sink.
Exactly. When we do the calculation to show significant decline in gross receipts, of course, we need to know what constitutes gross receipts. So how does the IRS calculate gross receipts for the purpose of the employee retention credit? It's going to include, obviously, any money that you receive in exchange for services or sales. It also includes, however, any investments, interest, dividends, rents, royalties, etc. So a nuance here. If you've got $1 million in your operating account and it's earning interest, guess what? You get to count that in the gross receipts test. Not reduced by cost of goods sold. So this makes a big difference for businesses that are selling goods. So if your gross receipts are 10 million and your cost of goods sold is 9 million, What do you use for gross receipts? It's going to be your 10 million. It's not reduced by the cost of goods sold. So give you an example. If we're talking about first quarter 2021 and your gross receipts were 10 million in the first quarter of 2019, what is the threshold for your gross receipts in 2021 to qualify? That would be $8 million. Again, not reduced by cost of goods sold. Significant decline in gross receipts, as Steve described, totally different tests for 2020 and for 2021. So the good news, as Steve described, they keep changing it. They keep making taxpayer friendly changes, fortunately. So for 2021, you only need to show a decline of 20% versus 2019 in that particular quarter in order to meet the significant decline threshold. So again, 10 million in 2019 versus 2021 with 8 million, that will qualify you for the first quarter of 2021.
Bottom line, 2021 got a lot easier and the government's giving you a lot more money. Good news.
A lot easier for those of you who are filing your first quarter 2021 payroll tax returns this week. You have two options. One is to file an amended return after you file your original 941, or if you have time today, do the calculation or call Steve and get on his calendar to do that calculation. All right. And
Cliff, we also want to mention, remember, amending is fine if you've already paid, but if you haven't paid yet, there's a different form to file. So the government gives you advance credit. So you say, instead of writing you the check I normally write you, I'm claiming my credit. You can give me the balance back in a check. So again, the government's giving it to you both ways. If you already paid it in, they'll give it back. If it's due, but you haven't paid it in, you have the opportunity to take your credit right now and retain the cash and not give the money to the IRS. This is fantastic.
Absolutely. So that's going to be something that you do mid-quarter typically. So if you have paid in, for example, for the first 2 months of 2021, and you know now with this credit that you won't owe for that last month, you can skip that last month's payment. You'd file the advanced payment credit, and it's Form 7200, and get that money back, and then you won't be obligated to make that last deposit. Another example, imagine gross receipts were 100, 190, and 230 for first, second, third quarter versus the 2019 quarters with 210,000, 230, and 250. So this is, again, in 2020, it was a 50% test. 50% constituted a significant decline. That was the minimum threshold. So in this example, what qualifies? Well, only that first quarter with the decline, 52% decline, gross receipts were approximately 48% of the 2019 quarter. Therefore, for 2020, and again, this is different for 2021, but for 2020, only that first quarter would qualify. So, again, in 2021, we're talking about a 20% decline as qualifying. So what kind of wages are are qualifying for the purpose of the employee retention credit. So essentially what you would imagine, which is what the salary is, we don't include payroll taxes, but we do include eligible employers' qualified health plan expenses. So you do have to make that adjustment. And so this is not, it's not simply a matter of looking at your 941. There will be some calculations involved to get to that qualified wage number. What is an allocable qualified health plan expense for the purpose of the employee retention credit? Those are only those which are excluded from the gross income. So anything, any taxable benefit, so anything that's included in the W-2 wages for which your employees pay tax is going to be excluded from this, the wages. So we're only talking about allocable qualified health care expenses that are not included in W-2 wages.
And that sounds complicated and technical, but the bottom line is it's the typical wages in healthcare that a lot of employers provide. This is what's going to qualify for the credit. It's what Cliff is talking about. That's the general rule that most employers do anyway and would qualify.
Good. So what happens if you own more than one business? So this is a little bit of additional calculation, but the bottom line is that you lump all of your businesses together, whether they are parent and subsidiary corporations or brother sister or a combined group of corporation. Those are all going to be aggregated for the purpose of all of these calculations, for the purpose of calculating gross receipts, for the purpose of calculating wages, healthcare expenses, etc. All of these calculations are subject to these aggregation rules. So you want to be careful if you own more than one corporation that you're including all of the corporations in the employee retention credit calculation. We talked about governmental orders earlier. What is going to constitute a governmental order that is going to make you eligible for the employee retention credit? Well, it's, as you might expect, these are orders from the mayor stating that the businesses must close, or that residents must shelter in place, or other local officials who are imposing curfew. Again, in most cases, we're talking about orders from mayors imposing curfews, preventing you from opening your business or closing your business. It also includes any orders from local health departments mandating any workplace closure for cleaning or disinfecting and those sort of services.
Cliff, just to that point, what about an essential business which was impacted by supplier slowdowns and government-related slowdowns?
So, I mean, in that case, Liz, you don't have to qualify for a governmental shutdown, because if your customers are not paying you because they're out of business or they've closed temporarily, you're almost certainly going to qualify under the significant decline criterion. But that does not, closure of your customers does not constitute a governmental closure. And what constitutes as a suspension of business operations? And again, if the government is allowing you to stay open, even though other businesses have closed, you're not going to qualify. If an employer operates an essential business, but has a partial suspension, then that you're going to look at that. It's going to be a facts and circumstances analysis, but it basically, as I said before, as long as some governmental agency is ordering you to suspend, you're almost certainly going to qualify under the governmental order prong of that test. As Steve introduced at the beginning, these rules are different for 2021. In 2020, the maximum credit was only 50% of qualifying wages up to $10,000. In 2021, the credit has been increased to 70% of the qualifying wages up to $10,000. That means a maximum of $7,000 per quarter. And this has changed actually since I drafted this slide, and now it is through the end of the year. So the $7,000 credit is going to $7,000 credit per employee is going to be continued throughout 21. So that's going to mean a total maximum credit of $28,000 for the year.
Per employee.
Per
So if you have
employee.
10 employees, it'll be $280,000.
$7,000 for each quarter is $28,000 times the number of employees, and that's going to be your maximum credit. Now we'll see there are going to be some limitations, and you're going to want to coordinate this with your PPP funds and other credits, but that's a whopping number. For a lot of people who had not received PPP2 in the first quarter of 2021, that means all of their wages essentially are going to qualify for the employee retention credit.
By the way, since Cliff mentioned PPP, PPP was set, PPP2 was set to expire today, but the Congress a few days ago extended it another 2 months. So if you haven't received any PPP, you can go out and get that too. The government is giving away the store. Now, never mind, there'll be all kinds of taxes coming up to pay for this that we'll talk about in upcoming webinars. But the bottom line is right now, to be on the receiving end of this, you have to go and apply for this, and it's free money. There's no tax on it. And if you spend it on the right things, you don't have to pay it back. And you get a tax deduction for it. So you get multiple benefits.
Yeah, it really is. There's sometimes when Steve and I are introducing some of these credits to our clients, they have a hard time believing that it's real. And why hasn't my accountant or attorney told me about this before? It is almost too good to believe, but this really is true. This is for most small businesses, it's in many cases enough to meet all of your payroll costs. So very valuable benefit. The credit is fully refundable as well. So that means for 2020 or 2021, if you had paid in fully based on your prior experience and you were paying payroll tax as you had in the past, you can now use this credit to claim a refund on an amended payroll tax return. So the way that would work is for 2020, the fourth quarter, if you're eligible, if you had more than 50% decline quarter to quarter versus 2019. You can file an amended 941 and recover some or all of the payroll tax that you paid for that fourth quarter.
And again, if you're thinking about doing it on your own, the government has recently revised the form 3 times, so you might not even be familiar with the current form. The bottom line is the government's giving the money away, and this can make the difference in an awful lot of businesses between going out of business and looking at a mountain of debt you have no idea how you're going to pay, and not only staying in business, the chance to rebuild and prosper. It's a big deal.
Certainly a lot of money for small business. Absolutely. So again, 2020, we're talking about a 50% credit on the first $10,000 in wages. And for most people who took PPP money, they really weren't concerned with it because PPP is forgivable for the most part. So that's free money, as opposed to this credit, which in 2020, until these law changes, you still had to come out of pocket for that payroll and then claim the credit on your 941 or amended 941. This year, again, for the fourth quarter 2020, it's not a double dip, but what it means is for any payroll that you paid with non-PPP money, you can go back and file an amended 941 for that fourth quarter and pick up to $5,000 per employee on that amended 941.
And that's why it's important to do the allocations, because PPP didn't cover everything. For example, employees making more than $100,000 a year weren't covered. So if you have somebody that was making $150,000, you'd say, well, I paid $100,000 with PPP, but the other $50,000 I didn't. So that's well more than you need to maximize the credit. And also remember, you only have to spend 60% on payroll. So if you spent the other 40%, say, on rent, you have lots of money left over here to maximize your ERC, your employee retention credit. That's why you don't just say, well, okay, I got this, yes or no. You want to go ahead and look at the calculations. The calculations are so important because that's what gives you the chance to maximize the money the government is going to hand you for free.
We're going to talk a little bit about how this interacts with the other credits, and this is where you probably want to hire an accountant rather than to do this yourself. Is that any wages for which the employer claimed the employee retention credit can't be used against the paid family medical leave credit. So you got to be careful there. You're going to have to go through each one of your credits and make sure you're not double dipping. So it's a very generous credit, but there's no double dipping. We'll talk about some other credit calculations.
And the advantage of going through these credits is you might find, hey, there's still another credit that I could utilize that I never even heard of. That's one of the things that you have to watch out for. And we get these all the time when Cliff and I talk to clients. Well, how come my accountant or my lawyer didn't tell me about this? There's so much in tax that's been around for basically forever. You know, Cliff and I have both been doing this for over 30 years, and a lot of things in tax were that way when we both started out over 30 years ago. But this stuff is all brand new, and they keep changing and changing and changing it. Even with the PPP, with the forgiveness, they just kept changing it and changing it and changing it, but they all made it more taxpayer friendly. That's why you need to have the most up to date to get the maximum benefit.
Yeah, and you're going to want to make sure that you're coordinating all of these credits and other government programs, because you don't want to leave any money on the table. And it's very easy if you're not paying attention to do that. I've talked to several clients now who are using some of the larger payroll tax services, and guess what they've heard about this, Steve?
Zero.
Nothing. So the big payroll companies are not going to help you out. Doesn't matter if you've had them use them for 10 years. They're not going to come to you with tax planning ideas or make sure that you're coordinating your credits in a way that you don't leave any money on the table.
And in fairness to them, that's not their job. Their job is to do something else. And this is our job, telling you here's the max you can do in coordinating these things and getting the max while you still can.
So again, this is fully refundable credit. So what does that mean? It means that the excess is treated as an overpayment. So if, for example, in the fourth quarter 2020 or first quarter 2021, that you've been paying in as you always did, then the excess will be applied to offset any remaining liability, and whatever additional you paid in is going to be returned to you. And you know, that's money in the bank. Talk a little bit about how to coordinate the ERC with unforgiven PPP loan proceeds. So now some of you have applied for forgiveness. Most of you are going to get forgiveness on 100%. But what if you don't? What if the SBA says, no, we're not going to forgive, 10% or 50% of what you've claimed? Well, guess what? You're not out of luck, because you can go in now and claim the ERC credit for any of those loan proceeds from the PPP that are not forgiven. So again, another opportunity. You're going to want to look at this after your PPP forgiveness application has been processed to make sure that you're giving credit for 100% of your PPP loan proceeds and that all of that is forgiven. And if not, you're going to want to call Steve and see if we can do the credit calculation, get some money back.
And, we've talked to you about the importance of these calculations, the accounting, to go ahead and maximize your credit. But there's another reason why the accounting is so important. And again, Cliff is very familiar with accounting, and I was a CPA before I was a tax attorney. Some of these are going to be audited. If you're audited, you want to have all the records right there available and say, you know what? I'm entitled to every penny that I took. Here's the record supporting that. Here you go. Goodbye.
Exactly. So, and you're not going to want to do that yourself. Here, so let's talk about how it works if for forgiven PPP loan money. So if you've taken PPP money and it's been forgiven, then you can't use that same payroll to support an employee retention credit refund claim. But in many cases, some or all of your payroll is paid out of pocket. It was not paid with PPP money.
And
so
also, there's
do?
something else real important to remember, because I don't want anybody to say, I got PPP and I paid it all in wages, and what are you guys talking about? And that doesn't qualify for me. Hold on. The PPP handled 2.5 months of payroll. And again, not the total payroll, just the payroll under $100,000, 2.5 months. This ERC for 2021 is dealing with 12 months. So by definition, no matter how much you got for PPP, it was only 2.5 months worth. So most of the year, by definition, most of the year, the payroll you paid was not with PPP funds. So that's another area. The bottom line is, we're telling you about exclusions and things that, well, this doesn't count and that doesn't count. But for the most part, again, I can't stress enough, PPP covers a max of 2.5 months. This is covering 12 months. So basically, for sure, 9.5 months could not have been covered with PPP. So the bottom line is even if you got, no matter how much PPP, there's an awful lot of ERC that you should be entitled to.
Take an example here. This is for you, March Madness fans. So, employer Ace Deuce.
Yeah, I saw that. Cute.
Receive $100,000 in the PPP money, and all of that would have qualified for the employer retention credit. And as part of the forgiveness application, the client Ace Deuce did not consult Steve, so they reported 100,000 as qualified rate wages for PPP, and they received a decision of forgiveness on the entire 100,000. What does that do to their ERC eligibility? Well, they get zero, right? Because Ace Deuce is deemed to have made an election not to take any of the $100,000 into account for the purpose of the employee retention credit. They instead took the position that this $100,000 was entirely used for payroll, qualified wages, and they reported that on their PPP loan forgiveness application. As a result, they get zero for the employee retention credit. So again, another
zero, Cliff.
Pardon me?
We don't like zero.
Nobody likes zero. So what should they have done, Steve?
They should have called us.
Should have called you. And then what should they have done on their loan forgiveness application?
That's why the allocations are so important that you were talking about. It's so vitally important.
So this client came and talked to Steve before they filed their forgiveness application, and they allocated $70,000 of the PPP money to other forgivable expenses besides payroll. And what does that do? They still got the forgiveness, right? The client still qualified forgiveness of the entire $200,000 in PPP money, but because they carved out $70,000 as non-payroll costs on their PPP forgiveness application, that freed up $70,000 as qualified wages for the employee retention credit. And guess what? What is $70,000 if it's just imagine that's $10,000 per employee for 7 employees. You're talking about almost $50,000 in credit. So the government will write you a check for $50,000, but only if you fill out your forgiveness application correctly, carving out these expenses as non-payroll.
Or bottom line, with the proper accounting, you get 100% forgiveness on the PPP and maximize your ERC. That's what it's all about.
What happens if you acquire a business? So very similar to the result with the aggregation of businesses that you own now, you're going to include all of the receipts for the acquired business when you're doing the computations. For each quarter, you're going to add that acquired businesses gross receipts and the acquired businesses wages to the original businesses receipts and wages when you run these calculations.
Cliff, just to refresh everybody's recollection, is this all assuming a 50% decline in gross revenue?
Only for 2020. So for 2020, you have to prove that 20% decline. So now we're for the most part, we're talking about amended fourth quarter 2020 payroll tax returns. So
And
for that,
remember, in order to qualify, it's one or the other. If the business shuts you down, that qualifies you. But for most people, you only had to be down 20% in 2021 as opposed to the 50% in 2020. So the big differences between 2020 and 21 is 2020 is 50%, 2021 is only 20%. In 2020, the government's only giving you $5,000 ahead. 2021, they're giving you 28,000 ahead.
exactly. So much more generous in 2021. And back to the clarification, we're still awaiting a lot of clarification on the brand new American Rescue Plan. But what we know is excluded, in which you can't double dip, are the R&D tax credit. We talked about the paid family medical leave, but also Indian employment credit and work opportunity credit, empowerment zone credit, paid sick leave credit. So you're going to have to go through your credit calculations. First of all, I know because we talked to a lot of people who come in and they're not claiming any of these credits. Some of you don't have a problem with double dipping because you're not claiming all the credits you're entitled to. But if you are claiming some of these credits, you're going to have to coordinate those to avoid the double dipping. Now, the good news is
most people never did a single dip. Most people have never heard of these things. Most people were never told by their attorneys or their accountants about these things. And a question that Cliff and I get all the time is, "Oh, so is this R&D? Is this new?" I say, "No, it's been around for years." "Well, how come my guy didn't tell me about that?" That's why you're here. So what I'm saying is, it's fine, no double dipping, but most people never heard of this stuff, much less taken it. So for most people, there's going to be an awful lot of people that qualify. And if you qualify, you should get the money that the government is literally giving you.
right. And so you just want to go through all of your payroll. So if you've got payroll, for example, let's use the R&D tax credit. So almost always, if somebody's eligible for the R&D tax credit, it's only going to apply to a portion of wages. So what you would want to do is go through, carve out those wages. You subtract your R&D wages from your total wages. You subtract the wages that you've paid with PPP money, for example, and that difference is eligible wages for the employee retention.
Cliff, I'm hearing somebody in the audience saying, "All these letters, what is the R&D credit? What are you guys talking about?" And the answer is, if you're in business and you have essentially an innovative process or a product, the government will give you money for that too. And on that one, you can go 3 years back. So if you're saying, "Hey, I think I might qualify for some of that, but I got the PPP and I got the ERC, so I guess no R&D for me." No. With R&D, you can go 3 years back. So the bottom line is, if you've never heard of this stuff, we'll tell you, would you be better off taking R&D or these things? And if you're better off with these things, that doesn't mean we can't go back to a year before the ERC took place, like 2019, like 2018, and get your money back for that too. So the way I look at it is not just no double dipping. It's, hey, we are making you aware of what this is. We've talked about R&D in previous webinars, so that's something you might be interested in too. And if you are, just let us know and we'll send you information on that as well. So the bottom line is, rather than double dip, you say, hey, I can go back to these other years, like 2019, 2018, and get it. So there's all kinds of government giveaways, but the problem is it's complex. And the other thing, the way I explain this to clients sometimes, these laws are so cumbersome, so burdensome. It's like, if I said to you, I'm going to put a check on your desk from the IRS for $1 million, and it's going to expire in 6 months, Would you take that check to the bank? I bet you most of us would say, well, yes, I would. But suppose, in example 2, I put that check on your desk, and then I backed up a dump truck, and I dumped 1 million canceled checks on that same desk, and then say, well, there you go. And you look at that, you say, oh my God, what a mess. You never get the $1 million check. And then some smarty pants says, well, the check for $1 million was right on your desk. Why didn't you take it to the bank and cash it in the 6 months it was good? Because you didn't see it because of all other stuff. Basically, that's how a lot of our laws are. There's so much in there. You just don't see it because that million pieces of paper are on the desk and you don't see the valuable one. So that's what we're trying to do is say, hey, these things exist and we know where that check is scattered among those other million pieces of paper that don't apply to you.
Yeah, and the other nice thing about the employee retention credit, Steve, is as opposed to some of these other credits that require you to be in certain locations or hire certain types of employees, or in the case of the R&D tax credit, requires you to carve out a certain salary for certain employees, fairly complex calculations. The R&D credit, I mean, as opposed to the employee retention credit, it's a totally different deal. So the employee retention credit is eligible. You're going to be eligible for.
You've already, what we're trying to say is you've already done it. So because you've already done it, the government says, hey, since you've already done this certain behavior, the government will give you money. That's what we're talking about. You've already done it.
Yeah, so very, very little work relative to some of these other credits. You certainly want to go for all the credits, but the employee retention credit is really should be on the top of everybody's list this year. So again, we're going to want to coordinate with grants as in addition to the credits. So most of you have heard about the restaurant revitalization program and the grants there that are rolling out now, and the other SBA programs in addition to PPP. There are several other grants given by the SBA. So we'll want to coordinate all of that together and figure out which combination of programs and credits creates the most dollars in your pocket. And it's not rocket science, but it certainly does take some coordination and some calculation to maximize the benefit. We talked about aggregation. We talked about businesses acquired. Now we have a similar issue when we talk about startup businesses. So what happens, for example, if you don't have any 2019 revenue or no employees in 2019, are you still eligible? So under the new program just rolled out a couple weeks ago, an eligible employer now includes what's called a recovery startup businesses. That's a business started after February 15th, 2020, $1 million or less in gross receipts. And those businesses are now eligible for the employee retention credit. And with that, Steve, we just have about 5 minutes left.
Well, in that 5 minutes, one comment I'd say,
go ahead.
The ERC applies to any type of business. But next week, we're talking about a special law that applies to restaurants. And restaurants is very broadly defined. Restaurants, bars, food stands, food carts. And they specifically left it very open, businesses that sell food and drink to the public. In this one, the government is giving you your pandemic losses. We're going to compare 2019 to 2020, and the government is going to give you the difference between your gross revenue in the pre-pandemic year and the pandemic year up to $10 million. But watch out for that one, because the government has earmarked a sum of money. When that money is gone, it's gone. This is first come, first serve. So that's something that you can look forward to talking to us about next week. And on that, let's go ahead and open the floor for any type of questions.
All right, Steve, we have one question. Or Liz, do you want to go ahead and read questions?
Sure. I think we've been kind of hitting them as we go. There was one about our business did not have a 50% reduction in revenue. Is it possible to use the PPP expense?
Absolutely. So you're still eligible. There's some confusion about this. So if your business qualifies for PPP, but you did not have a 50% reduction in gross receipts, are you still eligible for forgiveness? Absolutely, yes. So even if you're not eligible for the employee retention credit, you still are eligible for PPP loan forgiveness. It's a different set of criteria.
Great. And then just to reconfirm with the 50% with the ERC, it's comparing the first quarter of 2021 versus 2019, correct?
Yeah, so that's a little tricky. It's kind of counterintuitive. For 2021, you are not comparing gross receipts to 2020. You are which of course was a COVID year. You are comparing your gross receipts to the same quarter 2019. So it's a little bit counterintuitive, but you're not comparing year to year. You're looking back to 2019 when you're doing that significant decline calculation.
Think of it as before and after COVID.
All right.
Exactly.
And how about using ERC for sole proprietorships with no employees?
Well, it's not. You're not going to be an ERC candidate, but you know the other credits and the other grants you are certainly eligible for. So I know a lot of people originally were put off from applying for PPP because it was not open to sole proprietors, but now it is. So as Steve mentioned at the beginning, because the application window has been extended by 2 months, if you're a sole proprietor, absolutely, you should be applying for all the PPP.
And just so people aren't confused with the terminology, sole proprietor or independent contractor, you can still go ahead and do this.
Yeah,
and
absolutely.
Should they contact us for the PPP application? Are we still taking those?
So if you're going to contact us for the ERC, then what we're doing is we're doing the PPP 1 forgiveness as part of our ERC work.
Or any credit analysis work?
Or sure.
Yeah. Okay. And what will happen if we're an essential business who just missed the 80%, but we've been impacted by many local government shutdowns?
Well, it's one or the other. So if you're shut down, you're going to qualify.
But they were deemed an essential business, but they're affected by their because of suppliers and supply chain problems.
Then I would very carefully want to look at the records and see how close are they to the dividing line. Is there anything that they're including in gross revenue that shouldn't have been? Something as simple as you took a cash advance on your credit card to get you through a payday and you forgot about it. That's not revenue. And I see that all the time with small businesses where the owner is transferring money back and forth between personal accounts and business accounts. And then people forget as the year goes on. So that's the first thing I'd want to do is make sure, do they qualify there or not?
And I mean, I think this week we're seeing kind of the first round of the state of California and the DOJ prosecutions for COVID-related fraud.
Yes. Unfortunately, there's some people that take advantage of things. And yes, there have been prosecutions for that. So the bottom line is, obviously,
there's going to be some audits and there's going to be some, yeah, you don't want to be willful.
absolutely. So again, you want to get everything to which you're legally entitled, but you don't want to do something that, God forbid, will get you prosecuted.
And then how do you calculate, what's the fee structure for some of this, for the analysis or processes? I know that there's quite a few different.
Well, what I would say is that would depend on the magnitude of the business, whether we're talking this fee or that. So what I'd say is we have a free initial consultation anyway. Talk to us, and we would say the fee for you would be X, whereas your next door neighbor, the fee could be Y, because your businesses could be very different.
Okay, great. So this presentation was recorded, and it will be sent out to the attendees and put on our website for future reference. And feel free to contact us via the website at moskowitzllp.com, or feel free just to pick up the phone, 415-394-7200, and we can answer any additional questions or get you connected.
And I'd like to thank the audience for listening to us and watching us. I know I had a good time in presenting my part. I'd like to think my colleagues did as well. This is fun for us and a lot of potential money for you. And any of you that are listening to this that own restaurants, please tune in next week, because the government is just super giving this money away.
Great. Thank you all. Thanks, Steve.
Thanks to all.
Liz. And we'll see you next week for the restaurant program.
Very good. Thank you. Bye-bye.
Thanks. Bye-bye.